The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and this is our hour to talk taxes. And hopefully at the end of the hour, you're going to learn something that helps to save you money. And let's face it, in today's economy, we all need some tips. And I'm joined in studio again with my buddy, Chris Fabian. Hey, Chris.
Hello, Esther.
How's everything? You're cutting the grass today. I heard that.
Pulling the weeds. And I got to say to our Buffalo listeners out there, happy 716 Day.
Oh, that's right. It is 716
It's 716 Day. So
okay, so now what did you do because it's 716 Day?
I pulled weeds.
Pulled weeds.
Pulled weeds.
And
yes.
Tiffany Fabian. Hey, Tiff, how you doing?
Hey, happy Saturday.
Happy Saturday to you. You know, this time of year, half the year's over. We're looking at next tax season coming down the pike, and a lot of people call and they ask, if I make this much money, how much are my taxes? Well, I thought, people should see just how complicated coming up with that answer is. So I thought we'd talk a little bit about how your tax bill has arrived, and I think you're going to have your eyes wide open. So,
well, how about,
let me give you yes, sir.
I was going to say, how about the 1 year tax law changes that they put in effect?
Oh, well, we're going to talk about that too. We're going to talk about that too.
And then I just want to say, next week we're going to have Charmaine on. She's a expert at 401ks and simples and SEPs. And self-employed pension plans, obviously. And so have your questions ready. If you have 401 questions next week, she will be here.
Like, what happened to my money?
Yeah, right? Yeah. Well
okay,
said.
but let's just go into this so people will understand. When you ask the question, how much are my tax bill going to be, let me give you an example. Let's say you had a $100,000 W-2, and that's a pretty good W-2. And you're a single person. You got no itemized deductions, no kids. Your standard deduction next year is going to be $12,950. So your taxable income is $87,050. Your tax bill is going to be $14,768 in the federal, not counting the state. Okay, but let's say that your next door neighbor has the same W-2 for $100,000. Single guy, 2 children, got a divorce. He's able to claim the kids, but he decided because the real estate market was so hot, he was going to buy some rental property. And so even though he's breaking out even, he's got depreciation and everything, which makes him have a $10,000 loss. And he started a little business in the summertime, and maybe he's got a $25,000 loss there. That's going to reduce his $100,000 by $35,000, bringing it down to $65,000. And let's say he said, well, I'd like to put $6,500 in my IRA. Okay, that brings it down to $58,500. Now, let's say he's got some medical bills, some taxes, some mortgage interest, some charity. And so his itemized deductions come to $22,612, which he ends up with is taxable income of only around $22,000. So his tax bill is going to be $2,507 on the same $100,000. But because he's got 2 kids, and they changed the law, by the way, and hopefully they're going to change it back before the end of the year, he's going to save $4,000 in taxes. So this man not only doesn't pay taxes, he ends up with a refund of $1,493. So your next door neighbor, between you and the next door neighbor, both with a $100,000 W-2, is a difference of $16,211.
Wow. Huge.
I mean, because that's why it's not easy. But I thought it would be interesting for people to see just exactly how your tax bill is formed. And first of all, I think people need to know is that it's graduated. It's a graduated income tax, right?
Yep.
And what does that mean?
People will say, here's an example, I don't want to work overtime because then I'm going to make $135,000 instead of $100,000.
It's all going to go to the IRS.
And it's all going to go into that other tax bracket. Everything's going to be taxed at that other bracket. Or where should I stay so I don't go into that next tax bracket?
Okay, so let's talk about brackets. So this is how our tax system works. The first layer is at 0%. So if you're taxable, remember taxable income. This is after your deductions and your adjustments. Your taxable income, first 10,000 is tax-free. The next level, the first level is at 10%. The next level is 12%. So that means that it's only 2% more to go into the next tax bracket on that money in the next bracket.
That's right.
Then the next bracket is 22%. So you've paid 10%, then 12%, then 22%. But each level is where you pay taxes. And so it's not like it all becomes 22%. The first level is 10, the second level is 12, then the next level, let's say you have $1,000 in the next level, you'll pay 22% on the $1,000, but the other stuff leading up to it would have been at 10 and 12. Then the next bracket is 24, then 32, then 35, and the top rate is 37. The only way you pay at 37% is if your taxable income after deductions, if you're single, for instance, is over $539,900. If you're married filing a joint return, it's $647,850. That's a lot of money.
Yeah.
So in between all these or all those levels, you don't ever get to the 37% bracket all at once.
Yeah, I always tell my clients that your money lives in different worlds. And so don't stress so much. Go work overtime, get that second job, and it all is spread out. And so don't stress. There's a plan, and so thank goodness.
And the thing is, you don't see Bill Gates and everybody, and I know everybody's going to say, oh, yeah, they pay at a lower percent. That's because most of their income is in capital gains. And if you listen to us, we would tell you where to put your money to get these preferential tax treatments. But since most of their money's in stock, the maximum they pay is 20%.
Right.
Right?
Right.
That's right.
On their dividends.
Yep.
I'm Esther Gullius, the tax lady. 803-0930, 803-0930, star 930 on the cell phone. And you can text us at 716-803-0930. And we got a text that came in, Tiff, right?
Yeah, it says if you go over your projected income that you used for New York State of health insurance, do you have to pay 100% of the subsidy back on your 2022 taxes?
So they get health insurance.
That's a loaded question.
Well, you have to reconcile your income to what you reported to New York State when you filed for health insurance. So if you reported $50,000 and you have $51,000, you're not going to pay the whole subsidy back. You're only going to pay a little bit back.
That's right.
But,
because, in other words, you went over by the 1,000,
Right.
and when they computed the subsidy, they based it on 50. But if you're at 51, there might be a small amount of adjustment that you have to pay back when you file your tax return.
right.
Good
But
question.
if you
However, if you made 100 and you said you made 50 and they had a subsidy at 50 and you made 100, then you're probably going to pay back quite a bit.
correct, you're probably going to pay it all back.
Right. Probably all of it.
Yep.
All right.
Yep.
I'm Esther Gullius, the tax lady, 803-0930, 803-0930, star 930 on a cell phone. Text us at 716-803-0930. We're going to take a short break. We're going to be back and make you smarter than the average bear on the other side.
We are family. I got all my sisters with
Hey, you know, to us, you are family, and we want you to feel like if you have any question, and you might have said, well, I never used EG Tax, and I don't want them to start harping on me if I call them for tax, some tax information. We're not going to do that because we really do care about you. I really have always felt that if you take care of people, people will take care of you. And we do a lot of things with no strings attached. So really, if you hear something, I know this week I got an email that said, I was listening to your radio show last week, and you kept talking about that $20,000 pension exclusion. And I looked at my tax return, and my wife, her pension's over 20, my pension's over 20. We're over the age of 59 and a half, and all we had is a $20,000 adjustment on the state of New York. And so I said, well, we got to amend your return, you know?
Right.
And that's a wonderful thing.
Yeah, that's probably about a $1,200 savings for them.
Right, there you go. Hi, Esther Gullius, the tax lady, 8030930, 8030930, star 930 on the cell phone. You can text us at 716-8030930. Wanted to talk about some of the things that we thought they were going to keep in the law, but we can see that right now it doesn't look like it's going to happen. And that really affects what we're talking about kind of as tax planning right now. Is tax planning. The child tax credit is no longer going to be, unless they change it, and let's face it, before December they could, but right now the $3,600 is out.
That's
Right.
right. When so many people were counting on that,
Right.
They were getting used to it. You know, it's a lot of money.
So it went back to 2000, and the child care credit that was expanded, that went back to the original child care credit.
Yeah,
And
maximum
the earned
600.
income credit for seniors right now is gone by the boards as well, which really makes me sad because there were so many great things that were in the law last year that really help families. And unless you talk to your senator and congressman, and they re-put it back in the law, it's not going to be there. And that's a big change. You think about losing $1,600 per kid, right?
Right.
And if you have 3 kids, that's $4,800 that's not coming back to you.
Right. Where you may have adjusted your withholding.
Right. You better change it
Yep. Definitely.
because here we are, the middle of July.
Yes. Definitely
right.
got to take a look at your withholding and your
All right,
income.
let's talk to Leo. Hey, Leo, how can we help you?
Oh, Esther, I've been out of work for almost 2 years. I don't plan on going to work anytime soon, so I sold my house at a profit, and about $90,000 I got out of the sale. I've been living there for 7 years, and I was wondering, do I have to pay taxes?
All right, Leo, was it rental property at all?
No.
Then it's going to be tax-free to you.
Do I have to fill out a tax form to send to the government?
Well, there's a worksheet to fill out, but really, I don't think you're going to have to worry about it. No.
All right.
Well,
Okay, so
Leo,
good news for you.
Leo, let me ask you a question, though. Did you file a 2021 return?
Yes.
You did. Okay, just making sure because
Yeah,
New York
because
State.
all those credits are in there
Yep.
based upon that.
Yep.
Okay, and then we got a text here too, Chris.
Is New York State still sending out those nasty letters about tax owed on unemployment insurance income a person received in 21?
Well, the state of New York sends out nasty grams anytime they can.
Yeah.
right?
Well, this is the Department of Labor saying, please provide us proof that you deserved the
But
unemployment.
those
we
have
gave
pretty
you.
much slowed up.
Yeah,
those letters.
those have slowed up, but there's people are still getting them. You still have to respond. If you don't respond, don't be surprised if you get a bill in the
Right.
mail.
So
for
if the state of New York writes to you and says, prove to us that you qualified for the extended unemployment insurance benefits, and you ignore it, there's going to come a time here down the road where you might find something very bad happens to your bank account.
Yep.
right,
Right.
Absolutely.
So you want to make sure you respond, and if you've gotten that letter and you say, "Oh, goody, I didn't respond, and they haven't called me," don't think that they aren't going to. There's nothing going to happen because it will, and you can give EG Tax a call. We'll
That's
help
what I
you
was
to
gonna say.
to answer that, so you don't have a problem with that.
Yeah, call 632-7886 and we will help you.
All right. So going back to our original example in that same $100,000, right? To get to taxable income, you have all of your income that you report, and you can reduce your income by things that you can create. And some of the things that you can create, if you don't have a pension plan, would be an IRA, right?
Yep.
And wouldn't you suggest that most people not put money into an IRA until they see their tax person during tax season because they may not qualify if they have a qualified pension plan?
Excellent idea. Yeah, just set the money aside and plan on doing it, then wait to talk to us because it's such a confusing topic. Absolutely.
Right. So even though it's the next tax year, if you qualify, you can make that contribution up to April the 15th of that tax year, which would be retroactive. And that would be after you talk to your tax person, so you know how much you can put away, and you'll know exactly how much it saves you.
right. And because maybe you'll be limited to putting in $3,420.
Right, because of the phase out.
The phase out, right?
Right. All right, and then the other thing that you can create is a deduction for health insurance. I mean, health savings accounts, HSAs. Now, how does that work? Explain that to people.
Sure. If you have a high deductible plan, meaning I believe it's $1,800 for a single, $3,600 for married joint, you can contribute to a health savings account. That's different than an FSA because that's a flexible spending account, and that money you have to use it by the end of the year. If you don't,
And
you
that's
lose
through
it.
your employer.
And that's through your employer.
Right.
And
But the HSA is one that you just create yourself, right?
Right. You can be through your employer, or if you have your insurance through New York State Marketplace, you can go find a bank that offers an HSA and contribute directly to the bank. And then you would take the adjustment because it's not coming through your wages, it's coming
And
from
it's a
your
lot of
pocket.
money. For a single person in 2022, it's $3,650 if you have a high deductible plan. And if you got a family, it's $7,300. And there's a catch-up provision if you're over the age of 55 or older of another $1,000. So that'd be it'd be $8,300 that you could put into your HSA. That's a deduction. And if you were in the 20% tax bracket, that would mean that you save almost $2,000. That's a really good deal.
Yeah, and I've seen common mistakes with that. People will put money in their HSA through their employer, and there's an adjustment to income, and they take it, but you're not entitled to it if you put it in through your employer. Now, if you open up your checkbook
Because
and you
the
put the money,
employer didn't tax you on it.
right,
Right? Because these are after-tax dollars.
yeah, but if you open up your checkbook and you put it in that way, then there's an
Right.
adjustment to income waiting for you.
And a nice thing about an HSA, like I said, you can carry it over. It's like creating a second IRA where you
That's
may
right.
not be
I mean,
able.
think about it, because you can put your $7,000 in your IRA plus, let's say, $8,300 into your HSA. That's a lot. That's almost $16,000.
Yeah, I was talking to somebody the other day, and they're like, "Oh, I thought I had to use it, so I don't." They used it or something like that. But Chris, you're right, and Esther,
Okay.
you're right.
Yep.
All right, and then if you're somebody that's self-employed, even if you're on a W-2 and you have a self-employment on the side and you're making money, you can set up an SEP and put money into that pension plan as well. And I know everybody's thinking, who wants to put money into a pension plan? Have you seen my pension plan? Because of what's happening, you don't have to be in the market. There are conservative investments within a family of funds that you can put it in, so you get the tax benefit, and you may only get a 3% growth, but at least it's 3%.
Yeah, and then don't forget the employee match, and like you said, it reduces your taxable income,
Right.
and you usually don't miss the money, and just put it in something conservative. You don't
And
have to do the market.
over time, a little at a time, a little at a time, a little at a time, and you look back over 15, 20 years and you think, wow, I got a nest egg.
Yep. It adds up fast.
And
Right,
gone,
and then
gone are
the other thing
days
that
of
you can
pensions.
do is if you have stocks and you have losses, but you have dividends on the left-hand side and losses on the right-hand side, harvest those losses. So what does that mean? You get a plow? I mean, what happens with that?
Basically, yeah, you get a plow and you go through your investment account and you sell. I know, but I was trying to think of the farming term. Reap, harvest, you pull your losses out. You sell. If you have an ABC stock and you lost $5,000, you sell that. This way you can use that $5,000 loss to offset the gain you made on XYZ stock. So
Right.
then you pay no tax if you gained $5,000 through XYZ. So you got to use it to your advantage because
Right, but here's the thing. Everything we're telling you, if you don't do anything with it, look in the mirror today and say, it's my fault, because it's your fault. Because if you don't do it, in order for you to do anything, you have to change what you're doing. Because if you're just enjoying where you are, you're sitting on a back patio, having a beer, eating your hot dogs, and you don't do anything about it, believe me, nothing's going to happen potentially that's good. You need to learn how to make changes so that it affects your financial situation. And that's what this whole show is all about today.
Yeah, and one thing too, I know we're coming up to a break shortly, but if you remember last time the market crashed, when we were doing tax returns, people still had capital gains through their investments. They had through their mutual funds with that company buying and selling. So there's a lot of people out there right now going, oh, I'm not going to pay taxes this year because I'm not making money on my portfolio. I lost money. But don't be surprised come January if you have to report $5,000 worth of income, even though you lost $20,000.
Right. And that's where planning comes in. And I will tell you, we have time this time of year to go over. Here we are, mid-course correction. And especially since the child tax credit looks like it's only going to be $2,000 rather than $3,600, and the child care credit isn't what it was last year, you really need to look at everything because you may be very surprised at tax time if they don't change the law so that they keep the same situation as last year in the tax law. Right now, it looks like it's not going to be re-upped for next year, for 2022, and that'd be very sad. So you want to make sure you give EG Tax a call because we want to help you, right?
Definitely.
right.
By the way, before we take the news break, a lot of people want to know how much they can give in gifting. The gifting right now is $16,000 per person per year. So that's another thing that's just changed in the tax law as well. I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. I'm breaking for the news. I'll be back on the other side.
We are family. I got all my sisters with me.
Hey, happy summertime. I'm Esther Gullius, the tax lady, and to us, your family, we will certainly want to help you. So you can, one thing you will learn on Saturdays here are things that can help you to save money on your taxes, and that's what we're discovering here is just how to what creates your tax bill, and that's what's really important. And we have a text, right, Tara?
Yep, we do. So last year I got a large credit for childcare because I spent $12K for my child in a childcare center. Will that be reduced in 2022? I'm concerned. Should I use my employer option for childcare now?
Well,
So first question,
and
will
the
it
thing
be
is,
reduced?
I'm hoping that, because many times they put these changes in the tax law that expire, and then on December the 20th, they extend them. And that's what I'm hoping they're going to do.
That is one of them that is set to.
But it is, it's all set to go back. All of those
The
are
way
set
it
to go
was.
back.
Yeah.
But again, it's like the lifetime learning credit. They kept extending it and extending it and extending it. So, I think you have to operate as if it's not going to be in there. Now, here's the rub. If you use the employer option, that really is the best.
Right.
Wouldn't you agree?
Yeah. I mean, because that's a flexible spending account that you can put money aside pre-tax to use for your child care. So you get reimbursed when you pay the money. Your company reimburses you, but with your own money, that's tax-free. So it's not a bad thing. You save Social Security, you save Medicare, and you save income tax on putting that $5,000 away.
Right. And this way, if the law comes back in, then you get the difference between the two. Obviously, it wouldn't be as good as it was the year before, but at least you protected yourself now, and that's what this show's all about, to make sure that you know what to do. So yeah, I would do it.
Yep.
Right?
Definitely.
Okay, I'm Esther Gullies, the tax lady, 8030930, 8030930, star 930 on a cell phone, 716-8030930 is our text number. Okay, so going back to your tax return, the other thing that can save you money is rental losses if you have rental property. Even if it's breaking even, with the depreciation, it usually throws a loss. Obviously, if your income is over $100,000 to $150,000, it starts to phase out your deductibility. You're only allowed up to $25,000 in losses. And if you have losses over that, because your income is higher, you're going to have to suspend the losses until the year of sale.
Right. And, I did a consultation over during the week, and we want to pay less taxes, so we're thinking buying a house down south, and we're going to live in it for a while, and then we're going to rent it. And, it's going to be part rental, part personal. I said, well, okay, but unfortunately, that's not going to help your tax return. And they're like, but I thought rental property, you can take your losses. I said, but you're going to be using it more than 14 days, so you're not allowed your losses. So you got to watch what you're doing. And the same thing with the business, you know, I'm going to save money by losing money on my taxes. Well, if you lose $10,000, you've
lost $10,000.
Right. You may save $2,500 on your tax return, but you're still out $7,500.
Right, and so let's visit that. I mean, everything when it's a credit, if you get a credit, that's a dollar for dollar savings. But if it's a deduction, and a rental loss would be a deduction, that's multiplied by your tax bracket. So if you had a loss of $10,000, real money, you multiply that by your 10% tax bracket, and really you only save $1,000, and you lose $9,000, real money. So some people that think that they're so smart because they think they're going to get a big tax write-off, they are, but they're in such a low tax bracket, it doesn't make much difference.
Right. Yep.
Right. Okay, so and then after all of these things as adjustments, then you look at your itemized or standard deduction. Now, the standard deduction we talked about, and the itemized deductions would include medical expenses, taxes that you paid limited to $10,000, interest paid on mortgage and home equity, charity, miscellaneous itemized deductions, and casualty and theft losses. If they are more than your standard deduction, and the standard deduction is $12,950 if you're single, $25,900 if you're married filing a joint return, and $19,425 if you're head of the household. So it's kind of like, which is better, right? So you actually have to kind of visit the Schedule A to see if you'd qualify, so that you can see which is better for you, the standard deduction or the itemized deduction. And then, of course, to make things even more complicated, the state of New York says, well, we don't care that the federal government is limiting some of your deductions. We allow everything based upon how it was from 2019.
Yes.
Right.
Yes.
Right?
Absolutely.
Okay. All right. What do we got here?
There's a text. It says, if I leave my federal job for the railroad, can I transfer my TSP money to my IRA? And I hear railroad retirement is very good when it comes to paying taxes. So
Okay, I don't think you can.
I don't think you would want to.
I mean, your TSP, I think it has to be, but it is a pension plan. So if you're not working, then I think if he takes a lump sum, you can be able to roll it over into an IRA, right?
Right.
So you'd have 60 days from the time you receive the money, if you don't touch it, to put it into an IRA. So then you'd be able to direct it yourself.
yeah, and I would say the taxability of his federal job is similar to the taxability that he's going to experience at the railroad. I know a lot of clients get confused because the railroad uses a simplified, generalized method, but that just simply, I mean, do you think
Well,
it's
that
going
was
to
a while ago
it was
because
a while
you
ago.
used to put in post-tax
But it is
dollars
tax-free on
New York State.
On New York State. So
Just like the
because
federal.
it's a federally funded pension, it's completely tax-free in New York State, but it's fully taxable in the federal.
Yeah, so it's very comparable to his federal job, I would say.
Yeah, I mean, he's got a pension plan. Hallelujah.
Right. That's a dying animal. Smart.
All right. So then, after we come up with that, then we look at your tax bracket after you take all these expenses off. But then you get credits that further reduce your tax liability. And one of the credits that hardly anybody ever talks about is the adoption credit. So that's a lot of money, isn't it?
It definitely is. It's $14,000 some odd dollars that even if you don't pay that $14,000, you may be eligible for that credit of that much money. And your people are going, wait, what? How is that
and
possible?
it carries forward. If you can't
Right.
use it all in 1 year, it carries forward to the next year.
Right. And the way it's possible is if you adopt a special needs child. And that could be many different things. We'll stick with the obvious, a child who's disabled. Okay, that's where a lot of people think of special needs.
Right.
But it also goes to age of the child. Maybe you adopt a sibling group. Those are special needs children.
Explain what a sibling group might be, Chris.
A brother and a sister, a brother
Right.
and a brother, a sister and a sister.
Right.
Children
So
who
that to keep them together.
keep them together. Yes.
So that's a credit. So that would further reduce your liability. American Opportunity Tax Credit, which is what?
That's for college. And so that's for a college student for the first 4 years. And it's a wonderful credit. It's up to $2,500. You can take $4,000 of your tuition and fees, not room and board. And you can take it for each person in your household who's going to college for 4 years. And it's a great credit for college.
So that's that again.
it's
These are
both a
credits. See,
refundable and
these are
a
not
non-refundable.
multiplied by your tax bracket. These are actually whacking away at your tax bill. And so, like Tiff said, if you had 4 kids that are in the first 4 years of higher education, it could save you up to $10,000 in taxes. And on the state of New York, there's another credit for that, right?
Right. That's the New York credit for
The
school.
Empire.
Yep, the Empire.
No, it's not the Empire.
It's not that's the
Empire
Empire
State
Child
Credit.
Tax Credit. This is
Yeah.
your college credit for New York, and it could be
Right.
anywhere from $200 to $400 per student in undergrad programs, or you could use it possibly as an itemized deduction on New York State, which could save you even more money.
Right. And then there's also, which we've talked about before, when you are over the age of 70 and a half and you have to start taking money out of your pension plans and IRAs, there's something called a charitable rollover where you can take money that would have been on your RMD and roll it over directly from your IRA or your pension directly to a charity, and it fulfills the RMD and it's not taxable.
Yeah, and I just want to remind everybody in 2020, if you use the exclusion where if you were under the age of 59 and a half or even over the age of 59 and a half and you took money out of your pension under the CARES Act because you were impacted by COVID, you spread it out
Third
over
year this
3
year, right?
years. It's the third year in 2022, so make sure you plan. Many people were like a gulp this year when they filed because the thing is all the withholdings went on your 2020 return. So make sure you plan for the last year of not enjoying it.
I'm Esther Gillius, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. All right, so we talked about the child tax credit, right? So that looks like if they don't change the law, it's going to go back to the old way, $2,000 per child, right? Under the
Yep.
age of 17,
Right.
right?
Yep.
So last year it was 18, now it's 17. So that makes people sad. And of course, we also talked about the child care credit, which was 50%, but that looks like that's going by the boards. The earned income credit for seniors was so remarkable last year. Seniors over the age of 65 working got this earned income credit. Now it's just people between of 25 and 65 unless they change the law.
Right. The only thing I saw that they kept in there for the earned income credit was the investment income.
Yep.
They let that stay at $10,000 instead of bringing it back down
Right.
to $3,000.
Absolutely. I'm Esther Gillius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break. We'll be back on the other side with your questions. I'll talk to you later.
We are family. I got all my sisters with
Hey, happy 716 Day. I'm Esther Gullius, the tax lady from EG Tax. You know, anytime you have questions, I don't care if it's the middle of the night, you can always go to our website at egtax.com, ask the tax lady, put your question in, and I'm probably not sleeping either. So I'll answer your tax question right away. But then during the day, if you want to just talk to somebody, it's wonderful. We have people that'll actually talk to you, which is also an unusual thing because we really do care about you. So to us, your family, my phone number here in studio, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. And we have a text. What do we have here, Ted?
Yep. It says, I'm thinking of starting a new business. How can I get a tax identification number? And do I really need one? Does it cost a lot of money to get this number? I've been talking to people, as you say, over the fence, and I thought I should go to you.
Yeah, the whole thing is you don't need a taxpayer identification number unless you're doing a limited liability company or corporation, partnership, or you're going to have employees.
Payroll.
You can operate using your as a sole proprietor, you can use your own social security number. So no, you don't need one.
Yeah, and if you do go, you can go to you can go to irs.gov and you can click on get a tax ID identification number, and the cost
Online SS4.
Yeah, and the cost is zero.
Right.
Right.
There is no cost for it.
So it's an online SS4, right,
Yeah,
Chris?
but
Yes.
yeah, I would say that you
But
should
would you
come in and
recommend
plan.
that somebody just starting a small business get an EIN number right away, or do you think they should just operate as sole proprietor using their social security number?
I would just do my social security number. I mean, depending on the type of business, and then you, like you said earlier, like an LLC, would that be more appropriate because of the liability? And then you would need a tax ID number. But just a
And the
basic
thing
person,
is,
no.
it all depends. Like, for instance, there are somebody, like, let's say, for instance, you're doing babysitting, and the kids are being dropped off at your house, and you're worried about being sued if anything happened. Then you might want to spend the extra money to become a limited liability company, because if anything happens, all they can do is take the assets that the company owns, as opposed to everything else you own. But let's say that you're sitting home checking maybe bank accounts, and that's all you're doing is you're doing clerical work, and there's nobody you're seeing, and there's nobody that you think is really going to sue you. Well, then I think I would just operate with my employee in my social security number as opposed to getting an EIN number. So it all depends on. It all depends on the complexity of what you're doing and the litigiousness of the thing that you're doing.
And speaking
because
of-
we do live in a litigious society.
What, Chris?
Speaking of
Yeah.
employees, for the employers out there,
Oh, please listen to Chris.
yes,
Oh, employee retention.
don't forget about the employee retention
But
credit.
people don't believe this. I know they don't believe me
Right.
because they're not calling.
Right. Even if you had employees and you got the PPP money, you still may be eligible for
Or
the
if you made money.
right.
I mean, during COVID, your business made money and you got the PPP money.
You mean they could get
There's this
$80,000?
employee
That's
retention
not
credit
much.
that's being offered right now, and you can get up to we're not kidding, $26,000 per employee potentially. So maybe you only get $50,000. I mean, my gosh, that's a lot of money.
Only.
So give
At
us a
least
call.
call
Good
us so we
questions.
can help you.
Yeah, let us take a look and see if you qualify.
Right.
Do you want me to go to the other text?
Yeah.
Hi, I'm 57 years old. I recently retired. I'm collecting $35,000 in New York State pension. I'm also withdrawing $19,800 from my deferred comp. My financial advisor says I'm not incurring a 10% penalty because it's deferred comp account. What tax bracket will I be in? Also, I'm considering a part-time job. How much can I earn without bumping into a higher tax
Okay,
bracket?
so we
Love
got to
your show.
find out, is this person single, married?
Right, we don't know.
Do they have children?
Right.
So, I mean, that's what this whole thing is
But
about.
but she is right about taking money out of her deferred comp. She's not going to have to deal with the 10% penalty.
Well, how old is she?
57.
So
Because
she-
as long
so
as it's
gonna be-
systematic
she's not gonna
payments.
she's not going to get 19.8 as a subtraction in New York State, but she will get the 35,000 as a
as
a
the
subtraction.
pension. Right. But the
Right.
10% penalty was in question too on the federal. So as long as it's systematic payments, she will avoid the penalty.
Right.
So she's right about your financial advisor is right
Sort
about
of right.
that. Right, sort of right. Explain how they're sort of right.
Because if he just takes or she
Right.
just takes a lump sum check, you're going to get hit with the 10%
Right.
penalty.
So make sure
It's got to
you-
be a systematic payment
Yeah,
because
call
she's under
them.
the age of 55.
yeah, she's 57.
Under 59 and a half, yeah.
59 and a half, excuse me.
Yeah, and so call your broker and find out that they're systematic withdrawals. Make sure you're doing that. And then I think you should call Chris on Monday to find out what bracket you're in but if you heard Esther at the beginning of the show, I always tell my clients, don't stress over tax brackets because everything lives in different worlds. So I would say go get that part-time job and maybe put money.
Absolutely, especially if you need the money.
Yeah, I go,
Right, I mean,
go get that part-time
you
job.
need a mortgage to get your gas filled up anymore.
Yeah, I mean,
Okay,
don't worry
let's
about
go.
the
Okay, so
brackets.
the other thing that people should look out for is the sale of personal residence. I know a lot of people sold their homes last year. And if you lived in your home 2 out of the last 5 years and it's your personal residence hadn't been depreciated, then the gain up to $500,000 if you're filing a joint return is tax-free, up to $250 if you're single. That's a gigantic saving.
Just like we told the caller earlier.
Yep. Pension savers credit, that would be when you put money away into a pension plan and you're on the lower income spectrum. They actually give you money for being a good person over and above the tax deduction. They also give you a credit for that. So that's a pension savers credit. We talked about rental expenses. As long as you're trying to operate your rental as a business, that's your motivation, and you're not using it personally, and you're not renting it below fair market value, and you're not giving it to grandma for free, all those kind of things, and you're operating it with a profit motive, then the expenses after including depreciation, provided your income is not over $150,000, this is all these things, then you have a tax deduction with that as well. And don't forget, if you're selling your rental property, what else can you do?
If you have losses over $25,000 that were suspended, or if your income was too high and you weren't entitled to that, again, they were rainy day
But you could
suspended
do a
losses.
1031 as well.
They'll be resurrected, and also the 1031.
Right, the 1031 is a tax-free exchange.
Right, where you're
Right.
trading one property for another property.
Right. Don't forget, keep putting money in your 401k. Don't take the money out because the market's doing bad, because you're shooting yourself in the foot.
Yeah, business, we talked about businesses earlier too, and we talked about losses, but what about if you had a profit? What else is out there for a profit for a small business?
Well, you put money in a pension plan.
How about at the QBI?
Oh, and then you got the QBI, right? Qualified business income, where you can take a deduction for that too, which is absolutely correct. To Roth, a lot of times brokers are talking about moving money from your traditional to a Roth. Before you do that, call us, because it's true when you take it out, it's tax-free, except you get to pay all the taxes now.
Right,
Lucky
right.
you.
That's
And you just don't know how much that is.
that's the big question: to Roth or not to Roth. And
Right.
every person is individual, and you got to look at everybody's scenario.
Right, and you need to see the hard number. I mean, you want to roll over 100,000. You want to cough up $440,000 in taxes. Be my guest. But you're paying $40,000 now. Now you're alive. Now you could use the money. 20 years from now, you don't even know that they'll even have a Roth. 20 years from now, we don't even know if there's going to be a United States.
Right.
20 years from now, you might not even be here.
So think
Right,
about it.
right. And you
And
might
then
be in a nursing
529
home, and
plans,
who
that's
knows?
another thing you can do. State of New York for qualified education, right?
Yep. 529 is a good thing to do for New York for college if you want your children to stay in this lovely state.
And then, of course, student loan interest is still deductible.
Yeah.
If you're paying student loan interest. And don't forget, I think people don't know that if you're working for a not-for-profit and you consistently make payments on your student loans, at the end of 10 years, that loan is forgiven.
As long as you applied for the program.
Right, but that was my point. You got to apply for it. So if you've been such a good little person, made all your payments, and you never applied for it, they're not going to give you the deduction.
Yeah, and then don't forget, student loans have been suspended now for a few years because of COVID, and pretty soon you have to start paying them again. So don't forget to do, if you have been, that's great, but if you haven't. you
Well, and
gotta-
that just goes back to the other thing about, we're talking about doing things. If you're somebody that has large credit card interest and you're thinking about taking money, and you're stuck with all these, you're thinking money taking money out of your pension plan, look at, there are Capital One, I know, has 0% year and a half, zero interest on a credit card. So you can just pay off your existing credit card with the Capital One credit card, and you'll pay zero interest for a year and a half. That's pretty remarkable. Or you can use a home equity credit line because that would be much lower, maybe 4 or 5%, as opposed to a 20-25% credit card. So those are things that you need to look at so that you can get the biggest bang for the buck. You certainly don't want to do something dumb like take money out of your pension plan. If the credit cards are driving you crazy and maybe your credit isn't so hot, then borrow against your own 401k plan to pay it off, and then pay yourself back over a 5-year period, right?
Right.
That's right.
Exactly.
But the whole thing is, it requires you to do something. Right?
Nothing. If you don't do anything, you get nothing.
All right. And so we have our tax school where we talk like we love taxes, right? Where we talk about this in depth. And our school starts in October, and it's tuition free. It's absolutely great. With if you aren't computer literate, we have actually kind of a class
pre-class
within the class to teach you how to use computers as well, right?
Right.
So you can go to our website at egtax.com. Are we ready to go with that? Can
Yep.
we?
Yep. You can register right online at egtax.com. Give us a call at 632.
And don't forget, next week we're going to talk about 401ks and what you should look at. We're going to have a pension expert as our special guest. Until next week. If
And
you
then
need
coming
any
up
tax
is
help-
Kathy Anderson in a couple of weeks after that.
Okay.
Real estate.
In the meantime, give us a call if you need any help. We answer the phone and talk to people. 80309. Oh, nope, that's not. 632-7886 is our phone number in the office at egtax.com. You can email us if you need tax help. Until next week, have a wonderful week. Happy 716 Day. Thanks for listening. I'm Esther Gullius, the Tax Lady.